For decades, the only way to access Ray Dalio's famous all-weather strategy was to be a billionaire pension fund or a sovereign wealth manager with hundreds of millions to commit. As of last year, that gate is gone. The whole strategy now trades on the New York Stock Exchange under one ticker, and you can buy a single share for less than the price of dinner. The fund is the State Street Bridgewater All-Weather ETF, ticker ALLW. It launched in March of 2025, and just over a year later it manages roughly $1.25 billion in assets. It is actively managed by Bridgewater Associates, the world's largest hedge fund, and the expense ratio is 0.85%. So what is all-weather actually doing? Ray Dalio built this strategy for Bridgewater's own pension money back in 1996. The core idea is risk parity. Instead of picking winners, the fund tries to balance how much risk it takes from four different economic environments: rising growth, rising inflation, and falling inflation. The bet is that no matter which environment shows up, the portfolio is positioned to hold its own. Here's what's actually inside. About 73% of the portfolio is in nominal government bonds, around 44% in global equities, 34% in commodities, and 36% in inflation-linked bonds. If you added that up, you got something well over 100%. That's because ALLW uses leverage, mostly through futures and swaps. As of late 2025, total notional leverage was about 188% of the fund. Now here's what they don't tell you. That leverage is the engine that makes risk parity work, but it is also the single biggest risk in the entire fund. The whole design assumes that stocks, bonds, commodities, and inflation-linked bonds do not all crash together. In 2022, that assumption broke. Stocks fell, long bonds fell harder, and risk parity strategies took some of their worst losses ever. A levered version of the same idea would have hurt even more. There is also a second issue. 0.85% is a steep fee for what feels like a passive strategy. Compare that to a basic 60-40 allocation built from index funds, which can cost less than 10 basis points. You are paying for Bridgewater's active management, and the question is whether their decisions add enough value over time to justify that gap. Even so, the appeal is real. Since launch through early 2026, ALLW has returned roughly 14% total, in a stretch where the bond market was anything but kind. The investor pitch is simple. You get a single line item that does the diversification work for you, across asset classes most retail portfolios never touch directly. So who is this fund for? It's for investors who don't want to make a directional bet on growth or inflation, who are tired of guessing whether stocks or bonds win the next year, and who want one ETF that handles the asset allocation problem in a serious way. It is not a satellite. For some people, this is the core. One honest reality check. Risk parity is not a magic shield. When everything correlates and falls at once, leverage hurts. ALLW will have years where a plain 60-40 quietly outperforms it. The case for owning it is not short-term outperformance. It's resilience over decades. If this breakdown helped you, hit like, subscribe, and tell me in the comments. Would you trust Bridgewater to drive your asset allocation, or do you prefer to keep the steering wheel? I read every comment, and the best ones shape the next video.